Hello everyone, John Drennen, Sales Manager at Fairway Independent Mortgage Corporation here in Las Vegas. I am here today to tell you what you need to know because other lenders aren't. Tight housing inventory and elevated mortgage rates remain key headwinds for home buyers and home builders. Pressing need for more housing inventory, housing starts rise but is a pullback ahead. Home builder confidence hammered by elevated rates, more signs of a Fed rate hike pause, warning ahead of jobless claims. Pressing need for more housing inventory. Existing home sales fell 2% from August to September to a 3.96 million unit analyzed pace, reaching a 13-year low per the National Association of Realtors. Sales were also 15.4% lower than they were in September of last year. This report measures closings of existing homes and is a critical gauge for taking the pulse of the housing sector. So what's the bottom line? Tight inventory and elevated mortgage rates remain key constraints on home sales. There were 1.13 million homes available for sale, down from 1.23 million a year earlier, and nearly half the level seen since 2019. Plus, inventory is even tighter than the figure implies, as many homes counted are under contract and truly not available for purchase. In fact, there were only 702,000 active listings at the end of last month. NAR's chief economist, Lawrence Yun, noted there is a pressing need for more housing supply. Yet despite ongoing inventory constraints, homes continue to sell quickly, averaging only 21 days on the market. At 69% of the homes sold in less than a month, showing that demand is still strong for what's out there. Housing starts rise, but is a pullback ahead. Housing starts with measured at the start of construction of homes rebounded in September after reaching a 2-year low in August, up 7% for the month. While the bulk of the increase came in multifamily units, starts for single-family homes also rose 3.2%. Building permits, which are indicative of future supply, did decline 4.4% from August, while permits for single-family homes reached their highest level in a year. So what's the bottom line? Alicia Huey, NAHB chair, noted that the uptick in single-family construction was somewhat unexpected, as elevated mortgage rates have dampened home builder confidence. She added that starts are likely to weaken in the months ahead, which would further impact an already tight supply. In fact, when we look at the pace of completed homes, they'll be coming on the market around 1.45 million homes annualized, and subtract roughly 100,000 homes that need to replace every year due to aging. We're well below the demand measured by household formations, which are trending at 2 million. Even looking at future supply, building permits at 1.47 million annualized, we're still lower than where we need to be. The bottom line is that more demand than supply will continue to be supportive of home values. So home prices are crashing. No, they're not. We have 2 million people looking for houses, and we're annualized only having 1.47 million houses available. Warning ahead for jobless claims. Initial jobless claims fell by 13,000 in the latest week, with 198,000 people filing for unemployment benefits for the first time. This is the second lowest level of the year and marks the first time since January that claims have fallen below 200,000, suggesting that employers are holding on to their workers. However, continuing claims increased 29,000 as 1.73 million people are still receiving benefits after filing their initial claim. This data has moved higher over the last few weeks, indicating it's becoming harder for people to find employment once they're let go. While initial claims have been on a downward trend since hitting 250,000 at the start of August, a recent rise in announced layoffs via WARN notices could lead to a reversal higher in unemployment filings. The Worker Adjustment and Retaining Notification Act, WARN, is an important consumer protection that requires employers with 100 or more employees to provide at least a 60 calendar day advance notice of a plant closing or a mass layoff affecting 50 or more employees. So what does this mean? If these numbers are correct, we might be going into major layoffs at corporations nationwide, maybe some plants closing. We don't know what's happening with the auto strike. A lot of things are happening right now, so this forward data could be affecting us. Now, what to look for this week? More housing data is ahead, with September's new and pending home sales releasing on Wednesday and Thursday, respectively. Also on Thursday, look for the latest jobless claim and the first reading of the third quarter GDP. A crucial inflation reading will be delivered on Friday via the Fed's favored measure, personal consumption expenditures. The technical picture: mortgage bonds move higher on Friday, which is a welcome sign as they have been oversold and are due for a rebound. Support can be found at 98.5, while the next ceiling of resistance is way up to 99.697, which is the Fibonacci level. So there's quite a bit of room for improvement. The 10-year tested the resistance of 5%, which held, and yields ended the week trading at 4.9, and the next floor, it's 4.67. I know this is a lot of information, but I want you guys to keep 2 or 3 nuggets of information on the tip of your tongue. Number 1, supply and demand. The housing collapse is not happening. Number 2, interest rates are relatively high compared to they were a couple years ago. But guess what, people? People are still buying houses. People are refinancing. A lot of people are, there's plenty of transactions out there. I know you may work with other lenders, but I'm John Drennen, Sales Manager, Fairway Independent Mortgage Corporation, and now you're in the know. See you next week.